This is the APMEX Market Pulse podcast, your front row seat to expert discussions on precious metals. Welcome to the Market Pulse podcast. I'm Brett Elliott with APMEX, and I have today with me Philip Newman with Metals Focus, one of the founding partners and the managing director. Philip, thanks for joining us today. Would you please introduce yourself? Tell us a little bit about yourself and about Metals Focus.
Sure. Well, first of all, thank you very much for having me on your podcast. So I've been in the market for over 30 years. Metals Focus has been going since 2013. I'm one of three owners of the company, and we've got now over 30 staff in 8 locations. And what we do is we focus exclusively on precious metals research and consultancy. We do not trade the market. So when we put out a view, I would say it's a truly independent view of the market. And we're producing supply-demand work, price forecasts, cost analysis, looking at doré flows, all sorts of products. But that gives you a sense of the kind of things we put out there.
Great. And we're going to be talking today about silver. And kind of the theme of this is hype, hope, and hard truths. And it's really just a discussion about what are the expectations around silver and its prices, what's actually happened, and what's reasonable. So I guess my first question and sort of opening statement to this is we've seen over the last 5 years actually some pretty phenomenal performance by silver as an asset class. It's outperformed many of the others out there. Last time I looked, it was up about 113% over the last 5 years. S&P 500 was still pretty good, about 95%. We have silver outperforming the broader market. And yet, if we release a video on silver or we got into the forums, we see a lot of skepticism still. We see people saying silver's really not moving. It never does anything. What's your take on that? Why is there so much pessimism around silver?
Well, I think it depends on sort of how you break down some of the numbers. I mean, you mentioned on a 5-year basis, and that's absolutely true. I think if we perhaps bring a bit shorter term, I mean, some of those are very positive for silver. Some of those perhaps appear a little bit less so. So, I mean, this year, silver's up about almost 40%. That's a very strong performance. Mm-hmm. It's outperformed gold, outperformed Bitcoin. But then on the flip side, gold's at a record high this year, Bitcoin record high, US equities, in the same vein as well. So I think it depends on how you sort of slice and dice it. And of course, the other metric, and I'm sure we'll come back to this in the next few minutes, is the gold-silver ratio that I think a lot of investors do look at. And that is still, I think, pretty stubbornly high. It's in the very high 80s. So I think, for some of these reasons, investors, look at that and they say, well, silver is still, maybe 20% off its record high. But then look at some of these other, asset classes which have, comfortably managed to hit those new peaks.
That's a very good point, but wouldn't that also mean that we've got plenty of room to go until even more room to go until we hit those highs and more of an entry point, some might say, than gold currently?
I would definitely go along with that. And we certainly see that, I think, for some, say, institutional investors, they've done incredibly well out of gold. They maybe still be positive about gold going forward, but they say, even though they're positive, what is the upside from current levels? And so maybe there is more opportunity for them to invest in silver. I think, again, the flip side of that is that whether you're an institutional investor, a high net worth, or a retail investor, again, you look at what gold has done. You look at all the concerns out there. The old cliche is that silver is a much smaller market, much more volatile. It should outperform gold to the upside when gold is performing like this. And yet, to a large extent, we haven't seen that. Perhaps over the past few weeks, there were signs of that.
It's very exciting.
It is. I would very much agree with that. But I think, just going back, before silver did break out to the upside, it was struggling to some extent. And again, I think some investors would look at that performance. And I think the other metric, and I think maybe we'll touch on this a bit later as well, is that according to our data, silver is in a structural deficit and a sizable one as well. So you bring that all together, gold at record highs, all of the macro uncertainties, the silver market in a deficit, yet it's only very recently that silver seems to have broken out. So I think that adds to some of that disappointment or disillusionment that some investors may feel about silver.
That's a great perspective. It makes a lot of sense when you're seeing all these other asset classes at record highs and silver's not quite making it. What do you make of the claims that silver should be at $100 an ounce or $1,000 an ounce? You know, we've seen some numbers above $1,000 an ounce, which would, in my mind, would be pretty phenomenal. But what do you make of that?
Well, from our point of view, you know, whatever the metal we're talking about, you know, we are fundamental analysts, supply demand analysts. So from our point of view, we need the numbers to back it up, whatever the claim is for that particular price. So, for example, you know, in the case of silver, whether it's $50 or $100, you know, what's going to justify getting to that level, and is that level sustainable? Because when we think about when silver last got to $50, you could argue that was almost like a bubble conditions. It spiked up, it came down pretty fast. There were, I'd say, 2 or 3 attempts at that level, and none of those worked. And so from our point of view, if we say, okay, let's just argument this war game silver getting up to $100, you know, do we think that's sustainable? From what we would see, we would struggle to think that would sort of last. We think you would see incredible levels of profit taking by retail investors, institutional as well. Some of the price sensitive markets, I think, would fall sharply. And here I'm thinking especially of India, which is the largest silverware and jewelry market in the world. I think a lot of that would collapse overnight. And then some of the areas of industrial demand. And one of those in particular that gets a lot of attention is the photovoltaic market.
Solar, yes.
Solar. And maybe we'll come to that in a bit more detail later on, but just really briefly for now, we're already seeing incredible pressure on margins of much of the supply chain. And that's at these levels. So you talk about silver at $100 or higher. Well, I think that is a serious issue for the industry. And, you know, $100 silver, well, that industry, it focuses the minds. What can we do to replace silver? And once they replace silver, it doesn't come back. So again, do we think it's sustainable? Now, just to argue against myself, because I do this quite a lot, you look in the gold market and, you know, if we were having this conversation a year ago and we're talking about, well, what do you think will happen if gold gets to $3,000? Well, I would have said then you will see a wall of selling into that, you know, a lot of profit taking. Would it be sustainable, et cetera, et cetera? Well, not only was $3,000 sustainable, but look where we are today. There is incredible credibility in the price, say at, you know, north of, say, $3,300 gold. So markets can adjust. They can respond in a way that makes some of these new prices sustainable. So I guess that's a health warning I would put to my own statements if I can do that. But we are still really skeptical about a price that high of being 3 figures, of being sort of having sort of long-term viability.
It's a great point. And substitution is obviously always going to be, for any industrial metal, it's always going to be a concern as prices start to go up. Silver being extremely important for the energy transition, and also a relatively small part of the mix for certain types of products, such as in solder for electronics. There's an argument to be made that the cost is so small as a complete component of the end product that there's a lot of room for the industrial buyers to keep buying at current volumes and maybe do less substitution. Do you think that's a fair argument?
That's an argument that I used to put forward, if I'm honest with you. But, one of the things we do at Metals Focus is we get out into the market. We are speaking to manufacturers and understanding, what pressures they're under. And I think one of the key takeaways that we've had is that, you mentioned the solder market, great example. And you look, say, the automotive, where, it's really difficult to estimate how much silver is in the car. But let's just throw a number out. Let's just say there's 2 ounces in the car. Now, I know lots of your listeners could say it's half of that or quadruple, but the main point, so 2 ounces of silver, you look at that versus the cost of a car, it's nothing.
Right.
Absolutely nothing. And in fact, if you go and speak to an OEM about how much silver they have in their car, they won't know, because they're buying, say, a fully assembled dashboard or steering wheel or whatever it may be. But the way that we've learned to look at it, again, from speaking to the supply chain, is that if you go, to the beginning, where you have the companies that are they're starting with the raw silver, the grain or bar, and they're making a semi-finished product, that's mostly silver. And then that's being supplied up the food chain. And what they're finding is that there is incredible resistance and pressure to them to put up their prices. So you even think of the past few months when silver lease rates were pretty high, so their funding costs rose. And again, they're trying to pass on these costs, and there was incredible resistance. So they're facing the pressure. So that's where the pressure is to thrift. So if silver gets up to 50 or 60, whatever the price may be, you will see, again, their suppliers saying to them, we're not going to accept price rises. You've got to find a way to make this work. So you will see thrifting in all sorts of applications. Now, there are plenty where that's not the case. But something like automotive, and again, something like the photovoltaic, the solar market, that's very much the case.
Well, that's fascinating. There is a definitely a gap between what some of the expectations are. If you listen to some of the conversations online, there's a lot of people that seem to think, well, the amount of silver that's in a car is a rounding error for the final product. And that might be true, but if you're a mid-market company or you're just supplying the parts, then it sounds like that's where the pressure is going to come in, if I'm understanding you correctly. And then all bets are off. So that to us would indicate that substitution then becomes a much bigger risk.
It is. I think another really important point is that a lot of the trade, they remember when silver got to $50, which is not that long ago. And, silver is quite volatile. They want certainty in terms of what they're supplying, their products. Mm-hmm. And so what we've seen, again, I know I keep coming back to the photovoltaic, but it's a really interesting one for the substitution. It's one that we have a lot of debate with commentators out there. But, even when silver was, languishing a few years ago, you still had thrifting going on because they remember what they said when prices were record highs, and they're preparing for that again. And so it doesn't stop. Now, what we have seen is that the rate of thrifting can change. So the rate of thrifting, say at $40 versus $20, there are differences, but the thrifting carries on. It doesn't let up. It's just, the intensity does vary. So, for example, last year, we're fortunate. One of my colleagues based in Taiwan, he is our industrial guru, spends a lot of time on the Chinese mainland speaking to the photovoltaic guys, because that's where most of the industry is concentrated globally. And what we saw from his estimates is that last year, on average, you had about a 20% drop in average silver loadings. So even though you're seeing new capacity rise quite significantly, a lot of that is being offset again by this thrifting. The other thing, if I can just go into a little bit more detail, is that, there are lots of technologies out there. Now, I'm just an economist, and a lot of it I don't understand, and I do not pretend to understand either. Hence why we employ people that get this part of the market. But it's the speed with which these new technologies are taken on, and it's the speed with which they can just switch. So there was one that came on a couple of years ago. When it was first introduced, the average loadings were higher than the technology it replaced. 2 years on, that technology has migrated to a silver-coated copper powder. Now, that's not a big part of the market by any stretch. It really isn't. But that was being touted as, look at this new technology and what this could mean for silver. Well, silver loadings have collapsed in that particular part of the market. But again, just to stress, it's not a big part, but it just shows how fast the market can move.
So it sounds like, in your opinion, there is a certain amount of price sensitivity in silver, and maybe this kind of speaks to why the silver to gold ratio has gotten so out of whack, and we see silver to gold ratio at 90-1 so frequently these days. Is there a price sensitivity to silver that gold just doesn't have?
I think it's quite different. I would actually say that there's more price sensitivity in the gold market because from a demand point of view, one of the biggest areas is the jewelry market. Now that's a mixture. You've got Western demand, like in the US, where, it's sold in a fixed price, but you've then got, huge swathes of demand across Middle East, East Asia, South Asia. All of that is highly, highly price sensitive. The other area which is really important is what we call physical investment, which is coin and bar demand. And
we know about that.
A little bit, yeah, exactly. I'm in the right place. But that also, globally is highly price sensitive, be it gold or silver. But going back to gold, so most of the demand is more fairly price sensitive. On the supply side, also mostly price sensitive. Recycling of gold, mostly jewelry, same thing. Gold mine production is mostly a primary production. Whereas for silver, now, I'm treading on the toes of my colleague on the supply team, but you've got about only, say, 28% of global mine production is primary silver. The balance is either byproduct of gold or base metals. On the recycling side, the largest area is industrial scrap. And there, actually, one of the key factors is the gold price, not the silver price. Whereas, say, jewelry recycling or flatware or silverware recycling is a smaller area. So maybe that's a very long-winded answer to a very succinct question, but the price sensitivity is actually greater on gold than it is on silver.
So tying this back into the idea of the gold to silver ratio, and we're seeing that gold to silver ratio move up and up and up over time.
Yep.
If you look at the data from the past 30 years, I don't think we've seen the gold to silver ratio drop below 30. Pretty sure that the last time it dropped low in the 30 to 40 to 1 range was around 2011, which was actually the last time silver ran up to about $50. Now, since then, it's mostly been above 50 or 60 to 1. And, over the last 5 years, I'd say it's been over 70 to 1, the majority of the time. We do hear quite often that silver should be priced at a ratio of 6 to 1 to gold. Where is that coming from?
Well, I think that really has echoes of the ratio of mine production, which I think is now between maybe 7 or 8. So it's pretty close to the 6 you mentioned. But I think to your point, Brett, the fact that you said the ratio of the mine production of the two metals is, say, 6 or 7 to 1, but the ratio now between the two spot prices is close to 90. So there is no relation between the two of them. So I don't think that the mine production ratio is a good benchmark to even get close to that. The dynamics of both markets are just so very different. The composition of demand and the drivers of demand are so incredibly different. On the gold side, one of the exciting areas is central bank gold demand. I know that, on the industrial side, it's about the photovoltaics is one of the leading lights, but there's just so radically different between the two of them. I don't think that is something one should look to in terms of where the ratio should be. Even thinking that, well, the ratio now is getting close to 90, but then it's come down. The past 2 or 3 months, it's been trending low from, say, 100 to 1. So
that was a pretty phenomenal ratio.
Exactly. So I would say the ratio the past few months has actually been heading in the right direction, will write if you're looking for a lower ratio between the two metals. So that's, I think, has been a positive development over the past 2 or 3 months. But just to think that, oh, well, the long-term ratio is in the 60s, therefore the ratio should head back to that. We don't really take that view. Again, something I mentioned earlier, being supply-demand analysts, we would say, okay, what's the rationale for that? And I think even going back a stage, can we explain why, prior to the past few months, to your earlier point, the ratio has been trending higher? And I think that's always going to be our starting point. If we can explain that and understand that, does that then help us to think, okay, where does the future for the ratio lie?
I think it goes back to an interesting point of why isn't silver priced a certain way? And, there's this theory out there that the ratio should be lower, so therefore market fundamentals will eventually take hold and make it go lower. And that's how silver will get to $100 an ounce or $1,000 an ounce. But that's not what we really see in terms of, the fundamental price movements of silver or the fundamental price movements of gold. That's just not how they work. So let's go back a little bit in time. I think we kind of alluded to this earlier, but, there was a period where we had in the 1970s a run up to $50. And it was around $1.50 for an ounce of silver in 1970. And by the time we had the Silver Thursday event, it had run all the way up to about $50, which is about a 30 to 35x increase in the price of silver. So one of the arguments that we see out there is, hey, couldn't this happen again today? Because that's what would get us to $1,000 an ounce silver. And it's kind of used as a justification or a rationalization of a pretty extreme price target. What's your thoughts on this? Does that make sense?
Again, we've got to try to think about the conditions then versus now, and I think the silver market is so incredibly different for all sorts of, I think, incredibly positive reasons. So although taking a very big step back, we always say, well, silver versus gold, silver market is much smaller, therefore it's less liquid, more volatility. That's all fine. But let's put that to one side and look at silver in isolation. And I think to your point about could you see the run up in X terms? Well, I think the market is so much more liquid now than it was then. We look at how so many different types of investors now have access to silver. Now you could argue, well, that's a reason that it's so much more accessible, be ETFs, which I think were introduced in 2006, I think it was. Is that right?
Yes, right? It was either 2006 or gold ETFs and silver ETFs came out in different years. I can't remember which was which.
Yes, we had to fix that one afterwards. But but we've now got close to 1.2 billion ounces in silver ETFs. So that has brought widened the participation of those investors in the market. You look at the coin and bar market, which in the 70s, I'm not sure how much that existed. We started with in terms of the modern market, the Mexican Libertad introduced, then the Eagle, then the Maple Leaf, and so on and so forth. And if we look at, you combine that with the bar market, the retail bar market, our data, Metals Focus, starts in 2010. And, globally, you've had almost 4 billion ounces bought over that time through to now. So you've got a much deeper market, much more liquid. So you can argue that you've had a much greater participation. So if you do start to see a run up in prices, then maybe that would give you that momentum to drive it higher. The flip side of that is that much greater participation means that if you start to see a run up in prices, well, there's a lot more investors that can book those profits and give you that two-way market. And we haven't even touched on the futures. Yes, I know that on the COMEX it started in 33, but for much of the 20th century it was a Western phenomenon. Whereas we've had now a liberalization of the Chinese market to the extent that last year silver futures trading on the Shanghai Futures Exchange was a factor higher than on the CME. It's about 70% greater.
Really?
And so, the most commonly traded futures contract is a 15 kilo bar. So, you've got a much wider market. Now, again, you can argue that both ways. You could say, well, we've now brought the Chinese into this. So you're now getting much more participation in India on their MCX exchange, for example. And so, Indian investors by definition are bullish about silver. And so if you start to see a run up, then maybe that does say that, well, you would see an X times run up in the price of silver and hit new record highs. But again, I would just caution that you would see, I think, substantial levels of profit taking, which could counter that. One other point, again, I like to argue against myself. In India, I mentioned about India, I touched on it very briefly. I said earlier, it's the biggest market for jewelry and silverware in the world.
Yes.
It can sometimes be, it's one of the top 2 markets for retail bars as well. And our last statistic is a top 5 industrial player for silver. So it counts in all sorts of ways for the silver market. But what we've seen this year is that the rupee price of silver has already hit a record high. So I know we're looking for what's going to happen in dollar terms, but we've seen that in India already. Now, a few years ago, when the price ran up, we saw heavy liquidations of silver. We saw a collapse in imports. Interesting dynamics. This time, that hasn't happened. Investors have adjusted to that to some extent. Yes, you've seen jewelry demand back off, but you would of course see that, but it hasn't collapsed. So that's an interesting one about...
Why do you think that might be? Is it just kind of a side effect of inflation that the expectation is that things cost more, or are they expecting further price gains, or what do you think is behind that?
I think part of it is that the health of the economy is doing pretty well. A lot of silver demand is in the rural communities, and there is a very good monsoon this year, good for crop prices, again, good for their disposable incomes. And that has, I think, helped to partially offset or soften that impact of the record price. So I'm sort of arguing in favour and against, but we like to try and see both sides of the market. But it is really interesting that record price demand, hasn't completely collapsed. It's been really quite fascinating.
That's amazing. So silver being much more liquid, much more of a global asset class than it was in the 70s, maybe isn't fair to say that we should have similar conditions causing a similar run-up in price as what we experienced back then. We did have a run-up to $50 around 2011 in the wake of the 2008 global financial crisis. Arguably, a certain amount of precious metals investing was in response to all the government, unprecedented at the time, government stimulus that was occurring. So we can kind of explain that. But there is still this element, and I think you touched on it earlier, of, I think, skepticism because we haven't seen new record highs. And a lot of times there is a sort of finger pointing at the exchanges, and they say they're manipulating the price down. How fair is that?
To be honest, that personally, in Miller's Focus, we tend not to buy into the conspiracies. Again, we believe there are good fundamental reasons why the price is where it is. I think one of those, and we touched on it a little bit, how important industrial demand is to the silver market. And so that means that, say, the factors that influence silver can be different to, say, or have a different weighting, shall we say, compared to for the gold market. And so, economic growth is important, more important for, say, silver. And one of the countries that really matters is China. And so the past few years, you've had an incredibly weak, or say a property market that's been in crisis in China.
Yes.
And so that's weighed on industrial commodities. Silver behaves both as a precious and as an industrial. And to this extent, I think that has weighed on the silver price. but it can also become, I think, partly self-fulfilling as well. To my earlier point, investors look at gold, they read about the deficit and they go, is that it? And so it gives them a reason to perhaps do a long gold, short silver trade, or an outright short silver, whatever it may be. So I think these are the reasons what we believe, and it makes sense to us. Why silver is where it is. Again, we try not just to sit behind our desks and think about the market. We spend, say, a fair amount of time in New York speaking to hedge funds. What is their mentality? After all, I'm just an analyst. It's not my money. So, but what I want to do is get out there and speak to those who it is their livelihood. And, they are also, I think, they are not gold or silver bugs. But they can be gold or silver bulls. And there's obviously a big, big difference. I know when I was in New York in April, just after Liberation Day, and speaking to some of these really sizable hedge funds that are incredibly successful, making money or margin that most folks can barely dream about. And what really struck me then is how many of them were significant gold bulls for very good fundamental reasons, but they weren't really looking at silver. Their attention was on gold.
Interesting.
And that helps you also to understand from an institutional point of view, because that weight of money is where the short-term action is, and helps to drive or influence the prices, why that ratio maybe was stretching out at that time.
That makes a lot of sense. I think we're kind of getting towards the end here, and there's one question that I'm sure is going to be on everybody's mind. So if we don't think that $100 silver or $1,000 silver is necessarily, or anything in between that's necessarily reasonable in the short term, what is a sort of reasonable, healthy outlook for the price of silver? And how should we expect it to move in relation to other markets? Just
as an analogy, in the gold market, I touched on earlier, not just breaking through 3,000, but then, 3,200 being considered a low price for gold. I struggled to get my head around that, but, but that's where we are. So I think for silver, that's a really important starting point. And it's doing that even though some of the areas of demand are struggling. We talk about the coin and bar market. We're here. I'm in town for the ANA. One of the things that I'm here to understand is, how the silver market is behaving in terms of the coin and bar side. We've had maybe well over a year, maybe 18 months or maybe longer in terms of liquidations by retail investors. And so that weighs on the market. In spite of that, we still have the price holding up really well. And I think part of that does relate to the tariff debate. It relates to China and the US starting talks, then maybe over a month ago now, a bit further perhaps. And when I said earlier about how the Chinese economy or the property market had weighed on silver, the flip side of that, if the two countries are talking and there is a bit of momentum in terms of those trade talks, that is also good for silver. So I think we can be optimistic about that. Another thing which we look at from a price point of view, and I should have touched on this earlier when we're talking about the 70s versus now, is the scale or the importance of above ground stocks of silver. Now, we could do an entire podcast on that, to be honest. But we know...
Or maybe we should.
But we've had a market, I touched on this earlier, that's in this fundamental deficit. So you are drawing on these above ground stocks, mobilizing some of these to fill that gap in the market. But how long can that continue? And maybe some of those stocks being drawn down can also be price supportive. When we look at, there are some transparent figures we can look at. We can look at CME holdings of silver, their record highs. We can look at holdings on London Vaults that the LBMA publishes. Now, some of that's just been a stock transfer from London to the CME. But, those stocks in London are certainly much lower than they've been for a few years.
Yes.
And something that we look at, and frankly, a lot of the banks look at, is how much of that silver in London can be lent out. Because a lot of that silver is allocated against ETFs, exchange traded funds. And in fact, we spend a lot of time trying to work out, what funds are held in London, ETFs, et cetera, et cetera. And at the moment, based on the latest data, you've only got about 20% of that silver in London that can be lent out. It's never been that low. If you go back a few years, and I realize it's a bit of a segue from your question about prices, but 2021, we had the Reddit squeeze.
Yes.
And, there was concern then about the amount of silver in London that could be lent out and what would happen. We've gone well past that. So the reason I mentioned all of that is that maybe that is setting up conditions for a bit of a short squeeze in the market, just because, what is available to be lent out is relatively low. So I think the conditions are there for silver to do pretty well. And even if gold stalls, now actually we're quite bullish on gold, but let's just say gold prices stall and they hold at these levels going forwards, because of silver being in deficit, this could be positive.
So if I were to sum that up, sounds like there's a pretty reasonably strong floor under silver. We've got, I'm not sure if we would describe it as record low holdings in the vaults at the exchanges, but certainly very low. And an unknown amount of above ground stock available to replenish the supply. Is that a fair way to characterize it?
It is, yeah. I think in terms of the above ground stocks, it's people throw around all sorts of figures, but we've got to think about where it is, what form it's in,
yeah,
and who's holding it. It's hard to say which way it would go, but I think there could be a lot of selling in that. But again, and I realize I should stop arguing against myself, we didn't really see that in gold.
And I think something that we probably should clarify for the audience too is just how much of the price setting is happening in the exchanges. And you mentioned the form that the silver takes is very important. And, the reason for that, of course, is that the exchanges only take a certain type of silver, certain size bar. I believe it's 1,000 ounces with a tolerance of, is it about 100 ounces or something like that? I don't know the exact numbers, but that's really important, right? If all of a sudden we have a bunch of selling from the retail investors and they're selling silver maples, silver eagles, it's not like that's going to make its way into the exchanges to alleviate any of the supply issues that might be occurring there, unless it's first sent to a refinery and melted down into the right format, or they change their restrictions.
No, I think you've hit on one of the key issues in the market is how much refining capacity is out there. Now, you can argue that if someone, say, is selling back a 1 ounce round or a 100 ounce bar, it doesn't take much to melt that down and make 1,000 ounce. That's a pretty quick process. Mm-hmm. But if it's something which is much older, you touched on the maple, again, high purity coin, of course.
Sure.
But, if you've got all this metal coming out, it can just take time, just for that volume to be processed. One really interesting analogy you've had over the past maybe 18 months or so is that you've had large volumes of what we call silverware, I think more commonly known as flatware, I think in the US, being sold back in the likes of the US, Canada, parts of Europe as well. We don't know where this is coming from, but a lot of it's been coming out. And that is often sterling silver, so 92.5% pure or sometimes lower. Mm-hmm. And that takes time to be refined and to be processed. And you've had some refineries going, I don't want any more. I'm not taking any more. Or they've extended their lead terms or whatever it is. So you can very quickly, and if you're going to overlay that being sold back, and now you're putting 100 ounces and 1 ounce on top of that, well, now you've got bottlenecks developing in the marketplace.
Philip, thank you so much for your time today. Really appreciate it.
Thank you.
Thank you for joining us on the Market Pulse podcast. If you want more content like this, please subscribe or share with a friend. Your support helps us produce new content just like this. Thanks for listening, and we'll see you next time.